Okay, let's move on and talk about how to protect your long stock position by buying puts. So what we're talking about here is one of the actually most simple ways of hedging a position in a equity, in a stock, and that is by simply buying a put against it. So remember, if you're buying the stock, Microsoft in this case, you're long the position, you're thinking it's going to go up, but things don't always work out as planned, and you place your stop in, and if the market goes down and hits your stop, you're out. That's fine. But sometimes, and it doesn't happen too often, so the odds are not really there, but every once in a while the market will gap through your stop. And whether you have a stop limit or a stop market order, neither one really helps you that much. If it's a stop limit, your stop will not be filled. You will still own the stock at a much, much, much lower price. And so your position is decimated. If you put in just a market order for your stop, then you're going to be taken out. Your stop will take you out, but it'll also take you out at a very, very low price. And so again, your risk parameter that you initially had planned is completely destroyed. And so for example, if Microsoft gapped from $20 down to $2, not likely to happen, but we've seen some pretty bad gaps over the history of the stock market, some pretty bad ones. Well, your position is just killed. And it will take you a long time to make that back, either in Microsoft or any other stock happen to be trading. So hope that doesn't happen to you, but it does happen sometimes. It definitely does happen to some stocks, and sometimes it happens to good stocks. So that's really what we're looking for when we buy a put. In fact, with all of these three strategies I'm going to show you, what we're really doing is we're employing a type of insurance policy. And like insurance policies, you have some choices. The more insurance you want, the safer you want to be, the higher your premium is going to be, or you're going to have to pay for that. But on the other hand, if you're willing to take a high deductible, not have too much coverage, then you're able to have low monthly premiums. So it kind of goes that way with options too, although we're not talking about monthly premiums. You're coming in at a one-time cost. However, you may have a recurring cost if after that option expires you want to go ahead and put another option position in. So the choices are, again, how long do you want the insurance? You want it just for a few weeks? Do you want it for a couple of months? The more time you want to have that insurance, the more it's going to cost you, the higher the price of the option. And then, how soon is that insurance going to kick in? So we talked about the $20 strike price here, okay, which is roughly, you'll see that strike prices are not offered at every penny increment. The high volume stocks such as Microsoft, they trade, most strike prices are at every dollar here. Some will be every $2.50 or even every $5. So it varies depending on the stock. But here we get dollar increment choices. So if you want to get insurance right away, that's basically kicking in immediately, it's gonna cost you quite a bit. So in this case, again, we'll go with the ask, and the spreads are pretty tight here because this is such a highly traded option and stock. So it's going to cost you $1.34, or really, because again, one contract is 100 shares of stock, you got to multiply these prices by 100, so it'll be $134 to be so-called insured from $20 down. Now you might say, okay, well I don't really want to pay that much. I'd be willing to pay $89 or I'd really only want to pay $57. And that's fine. You can say, well, I'll just protect myself at $57, but then your insurance doesn't really kick in until Microsoft goes down to 18. So what you're doing, that's kind of like your deductible in a way. You're saying, I will be responsible. I will financially cover that $2 spread there. So if the market moves against me, well, I will suffer that $2. In a good place to kind of begin thinking about what strike price you use is where your stop goes. Okay, so I don't normally, again, we want to keep insurance as cheap as possible. And also remember that normally these markets are not going to gap dramatically against you. So this is for those rare times when it does. Those rare times can kill your whole year though. So it's important. But on the other hand, what we want to do is basically buy the cheapest insurance that gives us protection against a disaster. That's my philosophy of insurance. Everyone has their own, and that's fine. Depends on your financial situation as to which type of insurance is best for you. Varies from person to person and investor to investor. But so my approach may not be the best for you, but my approach is I'd prefer to buy the cheaper options. I begin by looking at where my stop goes. So let's say my stop is at $18. I might go ahead and put the insurance down here at even 16, and say, okay, well, you know what? For $21. 21 bucks, I'll have my insurance policy kick in at $16. Now, I could suffer a $4 loss in Microsoft. Normally, that's not going to happen because I'll get stopped out at 18 if that's where my stop is. But for those times that it isn't, and my stop is blown away, if it goes down to 10, well, I'm covered from 6 to 10. So at least I don't lose half of my position. Don't lose half of my money or more. And that's the good thing about buying a put, is it will cover you all the way down to 0. So as long as the options are still tradable and you can still sell it, it will cover you all the way down. So it provides great coverage for as low as that stock will go. You just have to decide where you want it to first kick in and how long you want to have that insurance. So that's how it works. Now let's pull up a risk graph and take a graphical look at the same thing. Okay, so the way we're going to pull up a graph, by the way, I'm using TradeStation Option Station, and this is a pretty good program. It comes with TradeStation, no extra charge. I think as long as you're doing so many trades or something a month, they don't charge you for this. Go to the TradeStation website and you'll see. So what I'm going to do is we'll go here to the Ask again, just because that's where you're sure to get filled. I'm going to right click on this. I'm going to insert a theoretical position. I'm going to go to buy, and I'm going to do a married put. And a married put means that you're buying a put and you're buying the stock. Okay, the position comes down here, and it defaults, well, you can change this in the parameters, defaults to buying 1,000 shares of stock and therefore 10 puts. So that's fine, but just to make the numbers a little smaller, let's change it to 10 and 1. Expiration is March. The strike price is 16th. We're buying a put, and the price is 21 cents. Okay, the stock, 100 shares at 1980, because that's the ask. Okay, great. So now we're going to right click on this, and we're going to create a position chart. And I click all of these. You can change these later. There you go. And I don't like this layout. Oh, you know what? I'm doing this on a different computer than I usually do, so I'm going to change this layout. I'm going to pause the video, and then I'll be right back. Okay, now here's the magic chart, and these are the risk graphs that I pretty much live by when it comes to options. So what we have here are 3 lines. I like to put all 3 of them on at the same time. And here's what they mean. The magenta line here, this one is the stock. So here's $20. We bought it $19.80, but let's just round it to 20 for convenience sake. So $20, we're basically even. And just looking at the purple or magenta line, pretty obvious. If the stock goes up, we make money. If it goes to 25, you know, we're making money. By the way, this axis over here tells you this is your profit or your loss, and this is the price of the stock. So now it's 20, but what if the stock goes down to 15? Okay, well, what you do is you just say, okay, at 15, and then you go over like this. You say, well, we're going to lose about $500. Right? It would be $500 in the hole. There's 0. Now, if it goes up to 25, come over here, then we'll be making about $500. So that's pretty much how that works. So this is just a risk graph of the stock, and it's always just a diagonal line like this. Now, the green line is the risk graph of your put option. Now, you'll notice, since the put option is a short position, when you buy a put, you're basically taking a short position. It's very different than the stock, which is just a diagonal line that intersects the 0 line. It doesn't keep going down this way. It goes up, and we're making money the lower the price of the stock goes. That makes sense. But here's the beautiful thing, is that then it flatlines here so that you do not continue to lose any more money. The most we're going to lose here is, well, what was it? $21, because we bought the put at 21 cents. And so then as the stock goes up and we're in a losing position on our put, well, it flatlines at $21. So we can lose everything we invested in that put, but it was only 21 bucks. Okay, and that's just a protection position. Now the blue line here, what that really is, it's a composite of the 2 positions, and that's the most important one. So this blue line shows you by buying this stock and buying this put, what is the overall risk graph look like of those 2 combined. So you can see that what that has done by buying both these positions, what it's done is our profit is pretty close to the same. If IBM, or no, we're with Microsoft now, if Microsoft goes up, we're still doing really, really good. It's almost the same as the stock. The magenta line's a little above the blue line. So that means the stock position would be making us a little more money than if we didn't buy the put, because we wouldn't have to pay for the put. Paying for the put takes a little money out of our account. But the magic is, as if Microsoft goes down, from here to here, as I said, the risk is pretty much the same as the stock, but then all of a sudden the put starts kicking in, and our risk flattens out. And so now, you know, if Microsoft went all the way down to $5, we'd be losing more than $1,400. Looks like about 1,500 bucks. But because we bought the put position with it, the most we're risking really on the combined positions is $400. And why is that? Well, that's because we bought our put at 16 with a $16 strike price. So we assumed the risk for 4 points down. But then our put kicks in and offsets the rest. And so it's saving us this. Okay, now just because let me show you a couple different perspectives. That is the current risk graph right now at this time and space. Let's go up here. Now what's the risk graph going to look like at expiration? And actually in this case, oh, it looks about the same. Now let's also look at, oh, I know what I wanted to do. Because this is a little deceiving, let's go ahead and change our chart. And we'll do floating here. There. And all I did was shorten up the, I just zoomed in, basically I zoomed in. So now you can see that the magenta line, which represents the stock, is a little bit above the blue line, which represents the composite of the two. So not making quite as much if you wouldn't have bought the put, but still pretty darn good, you know. Not giving up much profit, in other words, for protecting yourself to the downside. Now let's just take a look at a couple of other choices. What if we're willing to pay a little bit more? And let me pause this chart and bring up one. If we were willing, if we wanted to cover ourselves, we were willing to pay more for the put, and we wanted to cover ourselves a little better so that our downside would be less. Okay, so here's another risk graph. Now this one, what I did was I said, well, let me try a different put option. So instead of March, I went to April, just to give me more time again. So I went to an April strike price of 19 instead of 16. So now, again, my protection will kick in sooner, so I have less of a deductible, quote unquote, or the market doesn't have to go down as much before my put option will kick in and help protect me. However, because I'm asking for quicker protection on a drawdown and I'm also asking for more time, this option cost me a lot more money. Instead of $21, this one cost me $124. So now the risk graph, though, tells us a couple of things. We got some advantages and some disadvantages. So here we go again. We start out around 20 here, and the lines all intersect. You notice that the blue line again is the composite, and so our overall risk is much less. Now, instead of risking, roughly $400, now we're only risking roughly $200. So that's good. We like that. On the other hand, on the positive side of things, things are a little worse. There's a little more spread between the stock line, which is the magenta one, and the composite line, which is the blue one. And this blue one is what's going to be our real profits and losses by keeping the two positions. As long as those two positions are on, it's the blue line that is our investment. So the reason for that, again, is because we paid more for the option. And so that initial cost is going to be working against us forever. I mean, that's just money out of the pocket. So if this stock goes up, we lose that money. And that's what that's representing there. Okay, so hopefully that'll help you to understand some of the benefits and as well as some of the weaknesses of using this leveraging protection strategy of simply buying puts against a long stock position.